Political issues will be the key over the course of the next few days and weeks, particularly in Europe. We run into the weekend ahead of French elections. We also have elections in Greece, and what has been the sort of common theme that is beginning to build at this next phase of the crisis is the rejection of politicians who have been imposing austerity, and we are seeing some political change. So far markets feel as if they're coping with this potential change in the stride, but naturally it is going to cause some further investigation on the back of these results as to what impact this will have going forward, particularly as Europe is trying to come together to cope with the financial crisis. Is this going to lead to further fractions? So we'll be watching this reasonably closely. On the economic front, we also have important GDP data. So far around the world, GDP data has been poor, particularly even in some of the stronger parts of the globe. We were certainly last week hoping for good confirmation from the US that they were meeting expectations. I suppose one can't complain at 2.2% first quarter growth in GDP, particularly when we look at our own anemic growth here in Europe. But nevertheless, it was a number that came in shy of expectations. Again, we're broadcasting this just prior to the publication of the non-farm payroll report that is due out in the US on Friday. And this is a chart to start off with, which shows how this number has been moving since really the crisis began. Non-farm payroll, really looking at the employment statistics in the US. We see how the job numbers fell off very, very sharply, rebounded very strongly, but we've now been entering into this sort of phase of consolidation. The reason why today's number is going to be interesting for me is that there is quite a wide range on forecasts. The consensus is for a number of about 160,000, but Goldman Sachs made quite a big noise about the fact their own forecast is for 125,000, and they sit very much towards the low end of consensus. So this is very much a potential market moving piece of data. Now, turning to our own market here more closely to home, I thought it useful to just compare and contrast the 10-year performance of the FTSE 100 and the FTSE 250, just to try and give some indication of what is happening to equities on a comparative purpose. This here is the 10-year. This is the 10-year graph for the FTSE 100. And over that period of time, you can see that the sort of return over 10 years on this particular chart has been quite modest in the sense that it's showing about 10-12% growth over a 10-year period, with obviously plenty of volatility on the way. Compare that though to the FTSE 250, and you can see here that at the time FTSE 250 index was at 6,000, is now nudging nearer to 12. The return over 10 years for the FTSE 250 has been nearer 90%. So 90% comparing to, say, 10 to 15% on the FTSE 100. So the FTSE 250 has shown some very long-term outperformance. One can argue that the banking sector, which tends to dominate the FTSE 100, has been a factor in the difference. We did a little bit of analysis on this to have a look at what damage the banking sector has done to the FTSE 100 since its peak in 2007. And on broad measures, it's taken around about 1,000 points off the FTSE 100 during that time. But it still doesn't account for the difference, or much of the difference. And I think it's just worth bearing that in mind when thinking of equities, that often we do quote just the FTSE 100 looking for investment returns. That's often quoted in the media, but there have been some quite powerful gains that have been taking place in some of the more medium-sized businesses, where I think naturally some of the growth is coming from over time. Now let's have a look also at Spain, because I think again it's worth putting that 10-year chart into some sort of context. That this week we saw the Spanish IBEX print a 10-year low on the close, as demonstrated here on the chart. And I think it's worth reminding that if you were to sort of pinpoint the comparative performance of, say, the FTSE 100 from that 2009 low, the FTSE 100 at that time was around about 3,500. and we're obviously now nearer 5,700. So we've seen 60% growth since the low in the UK, whereas Spain has now eroded all of that growth. So a real sign here of the material impact that's having on its property, banking sector, and really just generally across the economy. Now, turning to a few stocks, I mentioned last week that the banks would be of interest for us this week. We've certainly heard, I think, reasonably encouraging news out of Lloyds and RBS. Both appear to be achieving their medium-term goals. The dynamics within a bank that are to be watched. It's not all about growth; it's about reducing risk. And on a number of measures, it looks like Lloyds and RBS are achieving their objectives at the moment. Share price has generally been firm in a weakened market, but for RBS and Lloyds, both have been highlighting net tangible asset values per share of roughly around twice the current share price. And if one can hope for a stabilised period for the banks to operate and continue to work out some of the bad loans, then there continues to be value buyers in the banking sector. Finally, just want to turn to consumers. Two stocks that are consumer facing, hotel businesses. I mentioned last week Whitbread, and that share price indeed has continued to power ahead, touching above £20. We look forward next week to results from International Hotel Group that they've actually burst through an all-time high for IHG this week. In advance of those numbers next week, we have a note on that stock, and it's an indication that well-run consumer-focusing stocks at the moment, all-time highs, it can be done.